Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right. Good morning. Welcome to the BOGART Effect. I've got Morgan with me, and we're going to be talking about year-end giving. I think there's a lot of ways that we can kind of approach this conversation. Even as we had back and forth preparing for it, it was, are we just talking about charitable? Are we going to be talking about gifting to kids and family members? Frankly, there's a lot of things to talk about at year-end. My perspective is it all needs to be done in a bigger plane. Right.
Yeah, absolutely.
And year end is kind of the opportunity to assess where we are, if there's anything strategically that we want to be taking advantage of, optimizing. Great time to do it. So
absolutely.
Why don't you kick us off? Probably more of like, what can you gift? And then let's talk a little bit about specifically as we go into execution with different strategies.
Yeah, absolutely. And obviously something you can be doing year round, but it just tends to be a Q4 conversation, I find, for clients. So let's talk about charitable and what can you give?
Okay.
You can give a lot of things you don't think about. So obviously the go-to and the default is checkbook giving, right? So it's putting cash in the donation plate at church or just writing a check for organization. So that's the default, but it's not necessarily the best asset to give.
You know what? Let's take a step back real quick. I want to frame it with itemized deductions. Like, what does someone even need to do in order to be able to actually qualify for gifts? And then from there, let's go into the minutiae. Like, when I think of the checkbook giving, like, I have a very bad habit. I put cash into the collection bin at the church. And I forget, but I don't, it takes me having to go back and like really remember what I did at the end of the year, as opposed to being a little bit more systemic. And we do some structured giving as well, right? But it's that little cash stuff to me is always the most dangerous.
Absolutely.
But in order to qualify for giving, first and foremost, you have to itemize on your tax returns, right? And so we know under the current tax structure, we get $10,000 for state and local property taxes. You get mortgage interest deduction. If you have a mortgage, you're capped at $750,000 of balance in order to be able to use that for an interest deduction. And then really the only other thing to get you to itemize is charitable giving. Yeah. And so that number this year,
$29,200. So if you're married, filing jointly, $29,200.
And under 65 gets a little bit more. But the point is that if, let's just say theoretically, you got $10,000 property taxes, let's say you got another $8,000 in mortgage interest deduction, so that's 18. You really need to be doing 11 plus of charitable to even be itemizing. So that year-end gifting conversation can become, let's just say, not as significant for a lot of households if they're not as altruistic or philanthropically inclined, right? So I just wanted to start there simply because some of this conversation is more of because we want to do it than it is because we need to do it for tax reasons, right?
Right. But I mean, you bring up a good point, because with the tax reform that we saw come out, 2017, it's been a while, and the higher itemized deductions, it's led a lot of people, the phrasing I hear now is cluster giving or skip year giving is another way you might hear it phrased, because that's a way to say, instead of giving in your scenario, let's say you give $10,000 every year, great, you're giving to organizations, you're not getting the tax benefit. What if we were to front load that and do $30,000, right, every few years so that you actually get the tax benefit?
Correct. And one way, and by the way, especially if we have a client that has a higher tax year, whether it's year of retirement, some taxable events created there, or we're doing some Roth conversions. Like we're loading up some more. So what are some of the vehicles we do this with?
Yeah, so I would say the one that I like the most and I personally use is a donor advised fund, right? So a donor advised fund, or DAF, if I abbreviate it, is a way that you can put appreciated securities, stocks. You can put cash in there. Homes, real estate, there's a lot that can go into a donor advised fund, but you get the tax deduction immediately. So you can put that $30,000 in today, but then you can gift it out in future years.
So I love that. And anecdotally, there are other mechanisms. We could use certain types of charitable trust if you want to do that. I mean, the administrative costs get very burdensome. Foundation, same thing, burdensome. So it really depends on the amount that we're talking about giving. So let's frame that a little bit. On any given year, we can give up to how much?
So you can give up to, well, you can give any amount. You can deduct up to 60% of your AGI if you're doing a cash gift. If you're doing appreciated stock, which I prefer, you can deduct up to 30%.
So
of
you
your
make
AGI.
$200,000. That means that you can give $60,000 worth of highly appreciated stock.
Right.
And the one thing I will say is, regardless of if we're trying to claim a deduction or not, if you're giving and you have appreciated stock, really want to minimize the checkbook giving and focus, regardless of deduction or not, because when it comes to highly appreciated stock, let's say we have a share of a company with $15 cost basis, and let's say that stock is now 120. Well, that's $105,000 worth of unrealized gain that if we sold it to write the check, then you're realizing the $105 per share of gain and having to pay the 15 to 23.8% on that gain to then write the check to the charity. Whereas if you just donated that share at $120, you get the value of the share at $120. The charity doesn't have to pay tax on the gain. So we get to skip out on that. And so from a strategy perspective, I'm going to tell anybody who's giving.
Always appreciate stock.
And frankly, I still like using the donor advice fund as the conduit to do it. I'm biased. I'm like you. I use donor advice funds. They're fantastic. It's like a checkbook for your charitable giving, right? And they have an online portal if you'd rather just, go online and have it send a check, or you actually can get a checkbook and write a check. The DAFs are awesome.
It helps with organization too, right? So when it's time for taxes, half the battle is gathering my documents, right? And going through, I'd put $50 here, going through all the little items. Well, if you're doing it through the donor advised fund, then it's all organized through there.
Precisely.
So it makes very simple come tax time, which I appreciate.
Well, and some of it then is looking at the cost base. I mean, there's some minutia that you got to then track down, right?
Sure.
But that's what we're here for.
Exactly.
So we've talked a little bit about the charitable giving. We've talked about some of the conduits. And we've talked a little bit about some of the framing on the tax benefit. Anything else we want to add there?
The other one I would talk about is qualified charitable donations.
Okay.
So as an alternative to...
And some people call those QCDs.
QCDs, or qualified charitable donations. So if you are 70 and a half, you are eligible to give up to $105,000. This is the first year it's been indexed, of your IRA directly to a charity.
Per husband, per wife.
Correct.
So $210. Total if you're married.
Exactly. And so for a lot of clients, I find a lot of them use the donor advised fund up to that age. And then when we flip to that age, it can be more advantageous because with the qualified charitable, it's coming right off the top, right? So it is a way to directly reduce your AGI, which impacts your Medicare Part B, right? And there's other things. So it feels like the same thing, but it's not. It can be a better way to
Well, and I think a lot of people assume QCDs in conjunction with their required minimum distributions. And what's happened is that required minimum distribution age has increased. It went from 70 and a half to 72 to 73 or 75 now under current law. So for everybody, if you're getting to that age, 73, if you were born prior to 1960 or later, age 75 is your required minimum distribution age. But this charitable piece, like this qualified charitable distribution piece, it's fantastic. Now, by the way, if we go back in history, we used to not know what the QCD number was
every year
until
let's wait and see if it passes.
December 15th, right? So at least now we can do some advanced planning on this. And especially for households that are in what we kind of call that RMD purgatory or prison, we love using QCDs. And this is one where it does not matter the amount. It could be $500, right? Whatever the number is to reduce whatever the required distribution amount is, because all of that's ordinary income. So if you're in the fortunate position that you have to take an RMD for $200,000 and you just really don't want it for whatever reason, we'd love to work with you, by the way, then that's a fantastic way to just use the qualified charitable distributions, donate the whole thing over to whoever it is. Caveat here, that has to go directly to the charity.
It does. It cannot go to a donor advised fund.
Correct. So it makes a little bit of friction on the planning piece. Like what we end up doing for households that are philanthropic is we kind of know the number roughly, and we'll then back that off of the required distribution amount. And then typically we'll still wait to do that gifting in fourth quarter. A lot of times it's circa Thanksgiving timeframe, roughly. Really like to, pretty much every institution wants to get done before December 15th, just for really more administrative reasons. But you get it up to $210,000, has to go directly to the charities, but that is another great way of reducing the required minimum distribution amount, which reduces your taxable income.
It can, and since it wasn't, deferred back to age 73 or 75, it still has 70 and a half. I also have clients who have inherited assets, right? So pre-2010, so they're not having to take their own RMDs. But when they're 70 and a half, and it's not the year in which, right, you have to celebrate that half birthday, then we can start to give from inherited IRAs with QCDs. So that's another really terrific way to go.
But I love that you mentioned a couple things with it. Medicare planning is a big part of this conversation. I think it very commonly gets overlooked. So Part A, everybody has, but Part B is directly impacted by whatever your modified adjusted gross income is. So those RMD calculations can have this creep, this hidden just kind of tax that happens as it's pushing up your taxable income. And I don't think a lot of people plan for that, right? I mean, it's one where at some point in life, you might get to a situation where there is just no planning you can do because the number's getting pushed up regardless. But the fact of the matter is this is a great tool. And by the way, if you don't have highly appreciated assets at that point in life, it's also a great tool to do it that way, as opposed to take the distribution, write the check. Just go ahead and do the gross amount straight over to the charity as well. Yeah.
I mean, clients will just give us a list. Here's the ones to go to. I mean, $50 is the minimum. And then we kind of send them all out for them and do it. So.
Yeah. And that's where I'd say whatever institution you're working with should be able to help facilitate that for you. All right. So we've kind of belabored on the charitable side of this discussion. Anything else we want to add?
I guess the last thing I would say, so one more before we move on, is just giving of your time, right? So this is a year where we like to volunteer. Like as an organization, we do a lot of volunteering. You can't take a deduction for your time. So you can't say, well, here's what I'd normally bill per hour. Let me deduct that. But you can deduct, so it's worth documenting your mileage driving to ABC organization. If you need to wear a specific uniform or outfit, you can deduct that. So costs related to donating or volunteering, you can, just not your actual time.
Well, and actually, you just triggered me to remember, some companies actually will do a gift on your behalf for the time you donate. So make sure that that's something, as you're talking to your employer or understanding your employer's offerings, that's one to make sure you're incorporating as well. All right, so other things at year end, right? So a lot of it is taking care of any type of annual gifting that you want to do to family, loved ones, people of importance. There's some certain strategies that we like to talk about year end related to that. Kids usually come forefront of this discussion. So to frame it, on an annual basis, we can do $18,000 of giving with no gift tax forms, no complexity, no receipt of gift. It's just clean.
Per person.
And that's per person. So husband and wife can give $36,000 to each child. Actually, sorry, they can give $36,000 to anyone without having to fill out any paperwork whatsoever. Personally, I think this kind of comes back to what is your plan, right? Like start with the plan, then we could talk about the appropriateness of gifting strategies, especially for non-tax related strategies. Because when we gift to using the annual gift exclusions, we don't get the benefit of a deduction, right? So we can't give to your kids, we can't give to nieces, nephews, et cetera, and get any type of benefit from a tax perspective from it. So we're doing it because we want to, because it creates value for us, whatever the reason is, but it's not done for tax reasons. But for planning purposes, there might be a lot of reasons why we're doing these types of gifts, especially if we're in a situation where there's a legacy conversation. And currently the estate tax thresholds are at a pretty high level, 13.71 million each.
Sounds right.
So 27.22. Yeah. Not that I'm counting. But as the end of 2025, that number is going to get under current law. Obviously, it's an election year and we're going to see some change. But we're guaranteed to see change. Just don't know what it is yet. But that estate tax threshold is currently set to go back to $5 million each. indexed up a little bit. If I had to be a betting man, it's going to be between 6 and 7 million, somewhere in that range. So if you're in the position where your total household net worth is over, let's just say 14 on the high end, and that's total, right? That's
home.
Equity in homes, portfolio, business interests, life insurance policies. If all of that throws us over the threshold, then we really want to start talking about some of these annual gifting strategies. And typically, if the money's going to the kids, then that's one of the ways that we want to do it. Yep. Obviously, philanthropy, we're assuming we've already checked the box philanthropy conversation, right? So now it's what else do we want to do? My personal preference of annual gifting as opposed to buying insurance and doing complicated trust is first and foremost, if we have the ability to give it to kids, that's the best way of doing it. Low cost, low friction, direct impact, can have meaningful value now.
Assuming we don't have a spendthrift or any kind of concerns, right?
Sure.
You know your kid, but there's some reasons we might say,
But honestly, related to that, right? Like then that's a scenario. If we're concerned about the kids actually having access to this money, there's no reason why, and self-included, my kids are young. I don't know. So I've set up trusts for them and I do the gifting into the trusts, right? Like they don't have control of it. They don't have access to it. And frankly, they won't until an age that I deem appropriate. Well, that's friction between my wife and I, but
definitely can go to the trust versus.
But that annual gifting can go to the trust as opposed to them outright, and that's a great way of doing some gifting that has a meaningful impact now. And then, of course, anecdotally, it can be things like we want to help them save for their retirement.
Yep.
My personal favorite, Roth IRAs. Yeah. So we can do $7,000 a year.
Into the Roth.
For Roth or IRAs if the kids are doing well and making over a certain amount of money. But Roth's money is growing completely tax-free, right? Yeah. So I love Roth simply because I think that if we're talking about a transfer of wealth from mom and dad to the next generation, well, mom and dad, they've probably got a whole tax thing that we're helping with, right? But the kids most likely are in a lower tax bracket. And if we could get money growing completely tax-free for them, well, I'm all for that, right?
No-brainer.
And let's pursue that as best we possibly can, which that's a lot of what this conversation is. So for example, if we're giving, Johnny and Susie $36,000 a piece, well, what I would do is right off the top, $7,000 is going into a Roth for them. By the way, the caveat here is they got to have earned income. Yeah. So let's find a way to incentivize them to work.
Yeah, exactly.
But we put $7,000 into a Roth for them, and then the remaining $29,000 goes into a brokerage account or whatever. And hopefully they're saving it, not spending it. But year end, it's a great strategy to take advantage of. Love that.
And there are some tax benefits, not like charitable, so I won't liken it to that, right? You're not getting the deduction. But if you have, let's say that same stock you talked about, you bought at 15, it's now 120. Well, if we give them 29,000 worth of shares in kind of that same stock, if your child's in a low enough tax bracket, the bottom two brackets have 0% capital gains.
Correct.
Right? So we can gift, sell immediately reinvested, and there's no capital gain tax. So there can be a little bit of a tax benefit or tax planning with.
I'm going to put an asterisk on that they're out of kitty tax.
Yeah, right.
Yeah, right. Yeah. So there are a sequence of laws depending upon the age of your children.
Yeah.
Let us help with that.
Yeah. Let's say they're 22, right?
Yeah, they're outside of kitty tax. Yeah. I only, because I could personally share, I tried to look at that and it was going to zing me. So I'm like, all right, that doesn't make any sense to do it. So I just didn't do it. No, that's great. Let's add 529s to this conversation, right? So 529s, well, let's say at college saving into this conversation, right? 529s are probably one of the, in our opinion, the best vehicles to use to save for college. And the difference, a lot of clients say, well, why not just save in my brokerage account or my Roth account? Or a Roth account for the kids versus a 529. Well, the thing is a 529 gives tax-free growth as long as the money comes out for qualified education expenses. And by the way, that can be $10,000 a year up to college.
Correct.
Then at college, there is no cap. It just has to come out for qualified education expenses, which is a pretty liberal usage of the funds. You can't buy the kids a car. You can't give them an allowance from it, but otherwise it covers a lot of it. I mean, housing, room and board.
Laptop equipment.
Laptop for specific. Yeah. So, and with the 529s, that annual number that we're using, the 18,000 each, well, there's a provision that allows you to do 5 years of that all into the 529. So for the younger kids, especially, or younger grandkids, this is a great way if you're really feeling generous and really want to get some money out. Well, we could do 180,000 right into a 529 for them. And frankly, a newborn that's getting that kind of funding probably is going to pretty close to set them up for most of their college expenses, if not all of it, dependent upon. The kickback a lot of times we get is we don't overfund these things, right?
Well, Secure Act gave us a little bit of wiggle room.
Bingo.
Right, a little bit. So there's a certain amount that we can roll to a Roth. There's a lot of qualifications that you have to meet, but there is...
Well, let's dive in. So it's 15 years.
Yep.
So
the account has to be open.
The 529 has to be open for 15 years.
Yep.
So mom and dad or grandpa and grandma that set it up when Johnny or Susie was first born, once they're out of school, and we're over the 15 years. By the way, this all just started this calendar year, 2024. So this is all new. But it's $35,000 can be used to fund a Roth.
Correct.
So that whole overfunding conversation becomes less impactful, right?
Less impactful.
And the other thing I'll note is we can always change the beneficiary.
Yeah, it could be for their unborn children. It seems crazy, right? They just came out of school, and so probably having kids isn't what you're thinking about, but technically it could be passed on to
or a sibling or a niece or a nephew, as long as it's a qualified beneficiary. So grandpa and grandma or mom and dad, whoever respectively set it up, they have the ability to always change who it is. The one thing I will say for advanced planning purposes is if grandpa and grandma are doing this, I would rather grandpa and grandma do it in their names with the grandkids as the beneficiaries, as opposed to mom and dad. Giving the money to mom and dad and then setting it up, simply because for FAFSA purposes, if mom and dad happen to be able to qualify for financial aid, needs-based, the monies that get put into a 529 get looked at. So, but they don't get looked at if grandpa and grandma have the money.
And that was also a recent change.
It is also a recent change, yeah. So, I think there's a lot of planning work that goes into it. I think, if we're going to kind of tie this all together, you have to have a financial plan. These gifting strategies are just part of a bigger annual conversation that needs to happen, regardless of where you're at in terms of working, retired, et cetera. Need to have a plan. And anything on an annual basis that we can do to optimize really is where, in our opinion, the value is created. Because any given year, there's never one strategy that solves all problems. It's the accumulation of diligence and steadfast execution that really is where the value is created.
And if you're a grandparent, let's say, listening to this and going, oh shoot, I should have done the 529, like they're at college age now. Just so you know, if you write the check directly to the tuition check directly to the university, then that does not count, is not subject to the $18,000 per person. So just there are some reasons that you can gift more.
Well, and actually, while we're on that thread, medical expenses, same thing. If it goes directly to the institution, right? There's a lot of ways to help your family without having to be imposed by these annual numbers. Now, while we're at it, because we get asked the question a lot, I want to help my son or daughter buy a house, and whether it's a year-end giving conversation or just something we're planning for. Just a wish, right? Just a goal. So a lot of folks, we think about this number, and let's just hypothetically say the number's $100,000. You want to give them to buy a house, right? And so, which is a significant number, but obviously more than the 36. Well, one of the ways of handling it is, because this is a goal that we have, let's start doing the 36 each year. And especially, by the way, if we're pulling that money out of a retirement account, it allows us to spread it out, as opposed to just pulling the $100,000 all out in one year, creating a bigger tax bill for you. Absolutely. So I like that conversation. But the other one is we can do a loan, right? Yep. So let's talk a little bit about what does that look like. It's a private loan between mom and dad. Yep. And this is a way where we could do the 100. But then over the next 3 years, we forgive 36, 36, 36. And by the way, that 18 is probably going to index up, but let's assume it doesn't. 36, 36, 36. Yep. We do have to assess an intra-family interest rate dependent upon the term of the loan. And they're reasonable. They're fairly low right now. Relative. I mean, they're set rates. Well, it's all relative. Yeah. 2 years ago, they were much lower, but basically
relative to mortgage rates, they're lower.
Fair. They're lower. But that's one way of doing this. And actually, while you're saying that, if we're in that planning mode where we are well above the estate tax threshold, maybe it is a conversation for mom and dad to be the bank and do the loan at a lower rate than what it would cost them to get a mortgage. That's another discussion that we can be having as well. So, I know this is about year end. There's a lot of ways to give away money. And I think, again, needs to be done all relative to a bigger plan.
I mean, even if you're thinking about a kid starting to buy a house, maybe they're going to look in the spring, right? So you can give them $36,000 now, January 2nd, $36,000, right? Just that knowing, hey, I can double it over 2 tax years, right? Straddle 2 tax years.
Well, not to mention that's in their names also, which does help them as they're getting ready to qualify for these things. Yeah. But which is another way. Not a deal breaker, by the way. We can always write a gift letter and it'll get it done. But I would say great reasons to have conversations with us, especially as we're coming into the end of the year.
Yeah.
What else today? We've covered a lot.
We've covered a lot. I think that's a lot of the items, just thinking about charitable. And again, just make sure if you're unsure about if this qualifies or what's the best way to do this, ask your financial advisor, right? I mean, I've had a client say they were paying for someone's medical expenses and they wrote the check to them. Let's write it to that organization. Yep. So just make sure you're looking at it, knowing that there's some little caveats to do it the right way. Talk to your advisor about it.
And if there's any one thing, my opinion, you take away from this is if you're donating money, regardless of taking a deduction or not, and you have highly appreciated stock, please don't write a check.
Do not.
Give shares, right? And almost every charity at this point has a brokerage account to have the ability to receive it. If that's not the case, then frankly, the donor advised funds are great ways of moving some money in, and then you can write a much lower amount based upon whatever you're trying to accomplish.
Yeah, and I mean, from the donor advised fund, as long as it's a qualified 501c3, it can go there. So correct. Even if it's a smaller church, I use it to give to my kids' PTA, right? I mean, there are any organization you can think of, if they are qualified, then you can use the donor advised fund.
Yep.
So.
Morgan, thanks for the time today. This was awesome.
Absolutely.
Thanks for listening. The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.